Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, our weekly look at the world of business and finance. This week, we're back to Europe. Ireland and Greece talk bailouts, austerity and collapsing banks. The IMF rolls into Dublin too. But is it all too late? Also, a year on from bankruptcy, and General Motors makes an astonishing comeback, though not everyone's feeling the positive mood. And a drop in lamb exports has New Zealand's farmers and its economy feeling just a bit sheepish. But let's start this week with a question. When you heard world leaders and economic players and business minds talking about an economic recovery, did you believe them? What about the so-called green shoots of economic growth? What happened to those? The reason I'm asking all this is because all the current indicators, be they official numbers or anecdotal evidence, seem to point to a slow, uneven, unemployed recovery, not just now, but for years to come. Here's what I'm talking about. First, the official numbers, and these ones come from the Organisation for Economic Cooperation and Development, the OECD. This is the group's twice-yearly economic outlook report. It predicts the global economy will continue to recover, but not nearly as well as we'd like it to. Have a look at this. And I'm not going to run you through each and every number because that's not what this is about. It's about the trend. Left to right on your screen, you've got four graphs. They are the OECD as a whole, then the Euro area, then the USA, and then Japan. So it's a pretty good wide snapshot. The bar headed south on each of those graphs, that is 2009, when everything went really bad. The other three bars, they are this year, and then the projections for 2011 and 2012 thereafter. Those predictions are all, look at them, bumpy, uneven, samey, if I can use that word. In Japan's case, even headed south again. There is not much there to inspire confidence in all the tough fiscal measures we keep hearing about. Confidence that they will actually return the economy to good, strong health. Perfect case in point is Ireland. They used to call it the Celtic Tiger. That was from around 1995 to 2007, a period of huge economic growth. Now that tiger is, I'm sorry to say, more like a meek little kitty cat. It's been the unwelcome focus of a series of emergency meetings of European finance ministers and a visit to the country by a joint EU-IMF team. The Irish government did bail out its banks with $60 billion, but the fear now is the nation may not be able to pay its huge external debts without more help. And you know that anecdotal evidence I mentioned earlier, the everyday hardships from everyday people, the small business owners, the taxi drivers, the things that tell the real story. Well, here's our correspondent Alan Fisher with some of those stories from Dublin.
Well, it's interesting you talk about taxi drivers, because I was speaking to a taxi driver when I got in a cab yesterday and said, how are things? And he said, there's just no money around. People in the past, when they would have jumped in a cab for a very short journey, now think, I'll take the bus or even I'll walk. So that is how the economy gets tightened. The taxi driver himself was saying that he'd had a carry-out meal the night before. He said that was a real treat. First time we've had it in a month. That's how it starts to get tightened. So people are living life differently because of the financial crisis. They're not spending as much money. That means the economy suffers, and that means jobs start to get lost. So essentially, people are saying we need stability, we need you to do something, we need to know what the future holds, and at the moment they don't think they have that.
So that's Ireland. What about Greece? There's a country that knows all about hardships and having to go to the likes of the IMF for a bailout. Well, Eurozone nations have agreed to delay the next instalment of an emergency loan to Greece. This was supposed to be paid in December, but Greece has had to admit it won't meet this year's budget deficit target. So the EU ministers decided to delay the payment until January and have asked Greece to look into, what do you know, further austerity measures, as if things weren't tough enough. Right, let's go to London now. Samar Al-Shehad has more analysis on the OECD report and just where Europe is headed right now.
Joining me to discuss what's happening in Europe right now is Jane Foley from Rabobank. Jane, thank you so much for coming in. Before we look specifically at Europe, I want to speak about the OECD report that's just come out. It seems to be pretty optimistic. It's telling us that recovery will take place globally, but it will be uneven, and that it would seem that unemployment is almost going to be part and parcel of the kind of the new economic lexicon, or a jobless recovery as
That's
such.
exactly right. The OECD have actually revised lower some of their growth forecasts, and really that is very much in line with what the market is thinking. Economic data is telling us that yes, the global recovery is here, but certainly if you look at the major economies of the world, so if you look at Europe, if you look at the US, what you will see is growth, but really at quite a disappointing pace. And of course that is, fueling in some cases high levels of unemployment. Certainly in the US, unemployment levels are considered to be, by many, unacceptably high, even though there is growth there.
Very much so, and we're beginning to see that in Europe itself. And again, staying with the OECD report, it's telling us that the banking sectors and the financial sector is going to become positive again, it's going to start lending again. But that's not the case in Europe. We've just seen that in Ireland. They've had to bail out their banks at something to the tune of 32% of the country's GDP. That's not a healthy banking sector.
We've got to put this in perspective. Ireland is a very small economy. Now, the figures that we've been talking about in Ireland with respect to just the liabilities of the banks, we don't know yet because they could carry on going as the economy throws up maybe more bad mortgages. But some analysts are talking about liabilities in the region of 80 billion euros. Now, to put that in perspective, the Lehman's, when that went down in September 2008, it was cited to have debts of around about 600 billion US dollars. So there's your perspective. Ireland is a small economy. The terms that we're talking about are huge for Ireland. Its tax take, for instance, in the first 10 months of this year was 24 billion euro. But in global terms, the Irish problem is not vast. Why it's so significant for the markets is because it could throw up cracks in European Monetary Union, which could then potentially bring down the euro. Politicians probably won't let that happen, or we certainly won't let that happen, but that's the story there. With respect to banks everywhere else, you're quite right, we had huge amounts of weaknesses. That's why we've been having Basel II, Basel III. Slowly but surely, the banks are strengthening their positions
But are they
in
really
general.
strengthening their positions? I mean, I suppose the big concern for many people looking at the European context vis-à-vis the American context is that the Americans sorted out their banks early on. They had stress tests that were deemed credible by the market. But in the case of Europe, we had stress tests, revealed to us on the 23rd of July in summer that told us that these same Irish banks that have failed so miserably passed these stress tests. So were the stress tests not credible, or were they not stringent enough, or were we lied to?
I would say maybe a little bit of all three of those. I mean, and certainly I think you have to be a very sophisticated accountant to really know the truth in that. For instance, within the Irish situation, promissory notes were written, for instance. So the Irish government didn't actually transfer all of the money they promised. They transferred about 4 billion, the rest was in promissory notes. The date on that is 2013. And yet these banks will be able to use those notes as an asset to get funding from the ECB. So again, there's a lot of grey areas here, which perhaps which we don't fully understand. But generally speaking, what we need to cure the situation is growth, because growth does feed the economy, it will feed the banking sectors. But as you've just pointed out, and as the OECD have pointed out, the growth outlook really for the next few years is very slow. And one of the main reasons for that in the US and certainly in the UK is because people were far too indebted going into the crisis, and therefore they're now fixing up their balance sheets, not spending very much money, even people who have the ability to borrow cheap funds.
And I think, I mean, you've hit the point there completely. Growth is the problem. Growth currently right now is the problem in Greece. Again, this week we've seen that it's not meeting, or it's not hitting its budget deficit targets, and that's why the Eurozone members now are going to postpone the payments they were going to make to Greece. It's now going to be paid in January instead of December. But Greece is pursuing the most stringent, the toughest austerity measures possible. Where else could it go? How could it reduce its budget deficit further?
Well, 2011, I think, will be a very interesting year to see whether or not Europe can stand the pain of austerity. And Greece really will be the case in point. Now, the budget that they have now announced is that it's about 14 billion euros of next year's budget. As you said, that's extremely painful. I don't know whether or not the Greek population will actually be able to stand that. But a lot of people say for Greece there was a lot of fat to cut, that we know that there were issues with respect to tax collection. It is quite possible that that can be fixed in the short term. Whether or not Greece, though, can sustain that level of austerity remains to be seen.
Jane Foley, thank you so much for joining me.
Thank you.
So things are still clearly very shaky across the continent and over the water in the UK as well. Not the best of times then for Britain's royal family to be preparing for their biggest wedding in almost 3 decades. And yet that is what will happen after Prince William, the second in line to the throne, announced his engagement to longtime girlfriend Kate Middleton. This will be, of course, no ordinary wedding. Security costs alone are already being estimated at up to 80 million British pounds. That is $128 million. Now, bear in mind, the Queen has already agreed to cut the total royal household spending by 14%. In 2012-2013. A royal spokesman said the couple were, quote, mindful of the economic situation, but insisted the royal family would be paying their share. Now, on the flip side, though, Britons do seem to love a royal wedding, and this has been viewed as a bit of light amidst the gloom of austerity. UK retail researcher Verdict reckons the domestic sale of royal wedding merchandise could come in around $41 million. Food and beverage retailers could be looking at a boost of $574 million as people celebrate the occasion at home, perhaps with a bit of champagne, something like that. And, you know, in a typical year, this is according to the tourism body Visit Britain, monarchy-related tourism brings in around $800 million in revenue. So in a royal wedding year, that number would only go up. And with all that riding on their nuptials, we say good luck to William and Kate. When Counting the Cost returns, we head to the bottom of the world, New Zealand, an agricultural nation where the sheep outnumber the people 10 to 1. So what happens when the lambing industry hits tough times? That and more in a moment. Welcome back to Counting the Cost, your weekly business stop right here on Al Jazeera. Let's look stateside now. We were talking growth predictions a little earlier. Here's the hard data coming out of the US on growth, but this is on a state-by-state basis. This is ahead of national figures next week. They're actually for 2009, but this is fresh data and not a healthy picture at all. They are what we call real GDP, that is growth per capita in actual dollar terms. Have a look. Delaware, top the list, at a shade over $62,000. That is 48% above the national average. The lowest in the nation, that was Mississippi, real GDP hovering just below $30,000 per head, 29% off the national average. And speaking of national, if you add up all the states, you actually get a decline in GDP of 2.1%, and you'd expect not much better going forward either. But here's some good news from the US. General Motors has made a huge comeback after going bankrupt last year. It no longer has the government as its majority shareholder. It is officially back trading on Wall Street after the biggest new stock offer in US history, and it opened at $35 a share on its return. We'll look at the reaction in a moment. First, here is John Terrett with a quick look back at how GM actually got to this point.
This grand-looking building houses the General Motors Embassy in Washington, D.C. They don't call it an embassy, of course, but that's essentially what it is. With losses totaling $88 billion between 2005 and 2009, it was from here that the GM bosses lobbied the Obama administration to hand them a $50 billion bailout in loans and stock purchases, meaning US taxpayers owned 61% of GM. All that cash from the US Treasury earned the firm a new nickname, not General Motors, but Government Motors. But now 43% is the new federal ownership target level, with the Treasury selling a third of its stake in GM in what began as a $13 billion initial public offering. The Treasury is selling the stock at a loss to stimulate interest in the sale, which they hope will drive up prices so the government can sell the remaining two-thirds for a profit somewhere down the road. All this is taking place just over a week since GM said global sales have risen by 5% this year, with 2 million vehicles sold so far, and bringing third-quarter earnings to $2 billion. With 3 strong quarters this year, GM says it's on course for its first full-year profit since 2004. How long before it can stand on its own 2 feet without any government ownership remains to be seen.
Yeah, so with that sort of history, no wonder General Motors' refloat, if you like, has been heralded a great success. But in Detroit, the heart of America's car industry, the place they actually call Motor City, there is a different story to be told. MTS Tayyip has that story.
Well, I'd say the feeling here is a bit more subdued than what we've seen on Wall Street. And I think opinion here is a bit divided. On the one hand, you have people who are quite happy that General Motors has made this splash on Wall Street. The share, of course, rising higher than the $33 that was expected. So certainly very happy about that. And in some ways, seeing this company turn the proverbial corner. Yet on the other hand, there are some people who are expressing a bit of skepticism over the future of this company. It seems to be an awful lot of investor confidence. They're waiting to see whether or not that's going to translate into consumer confidence. Now, although GM has certainly seen the best year that it ever has in a very long time, they do question whether or not that's going to continue for the foreseeable years to come. So a lot of questions still linger for people here in Detroit over the future of GM. Keep in mind, General Motors shares before its collapse was one of the most widely held and widely traded shares here in the United States. And of course, for those who worked for the company, who had invested huge amounts of their retirement into this company, they effectively lost everything. So the fact that this company has returned to Wall Street in a very dramatic fashion, that doesn't necessarily mean that these pension plans will return, that these savings that were lost will return. So for a lot of people, on the one hand, they're happy that GM will exist for the foreseeable future. It certainly doesn't mean that the awful losses that they faced when the company effectively collapsed under its own weight is going to be recouped in any way.
A little bit of tech news now. An anniversary, actually. This month sees the world's most famous computer operating system celebrate its 25th birthday. Believe it or not, Microsoft Windows wasn't hailed an enormous success when it hit the market back in 1985. Several other similar products had already been created before it, including some by a little company called Apple. But despite its lukewarm reception, Windows grew, it underwent numerous improvements, and of course it's now used on almost 90% of the world's computers, so clearly a success now. Oh, and it made Microsoft's co-founders two of the world's richest men, but I'm sure that's just a minor detail. To a story now from a place close to my heart, my home country, New Zealand, which has failed to meet its quota of sheep meat exports this year. Now, believe me, this is serious for a country like New Zealand. Agriculture is a huge part of the economy, and farmers now say the industry is in real trouble because of plummeting profits. That is in spite of record prices. Gerald Tan has more now from Napier on New Zealand's North Island.
Crisp winds sweep in the rain clouds as a cold snap descends on the countryside. After a brutal spell of back-to-back droughts, this should be welcome reprieve for farmlands. But spring storms earlier in the year killed roughly 1 million sheep, resulting in New Zealand's lowest lamb yield in nearly half a century. In classic supply and demand economics, world prices shot through the roof. The hot trading, though, has not translated into cash in the pockets of farmers. Hundreds are now walking off their land because of plummeting profits.
The markets are crying out for New Zealand lamb. We've got a disconnect with sheep farmers here struggling to make ends meet, very high prices offshore, but we've just got a whole lot of inefficiencies in the middle.
A long supply chain is involved in getting the lamb from the pastures to the plate. After processing and packaging, it's then shipped to the highest bidder. About 95% of New Zealand lamb is exported, earning in excess of $4.5 billion annually. Still, farmers contend that figure could be far higher. Many find themselves undercutting each other in the pursuit of buyers. It spurred some to call for greater consolidation to achieve a more unified voice in negotiations.
One of the issues for doing that is whether our overseas customers would accept a single desk selling type of operation. While in theory it makes sense, in practice it may be very hard to implement on the global stage.
A similar structure currently exists in the dairy industry. The cooperative Fonterra processes more than 90% of New Zealand's milk, giving it clout in setting prices. For Bruce Wills, that's the model of ownership sheep farmers could be working towards.
I think we're sitting on a knife edge at the moment. If we can get these structural issues, if we can get some profitability back to farming, I think there is a good future.
It's a future that needs to be shaped now, as the average age of sheep farmers is 59, and the lucrative fields of dairy and forestry are attracting many to cross the fence.
In a nation where sheep outstrip the population of people 10 to 1, it isn't difficult to stumble upon bucolic pastures such as this, but that could soon change. The number of sheep here today is less than half what it was just 30 years ago, and low profits are driving even more sheep farmers to close their gates for good.
There is more tension between the US and China, this time over a range of economic, defense and security policies. In its annual report, the US-China Economic and Security Review Commission has accused Beijing of being a currency manipulator and says Washington should address the issue at World Trade Organization level. It argues China's advances in missile and aviation technology could threaten US military interests in East Asia, and voices concerns that China may be supporting cyber attacks. All quite serious, all quite complicated too, but we liked this little explanation of the US-China relationship. Take a look.
We are both superpower economies, locked in a battle over monetary policy. For social stability, we got to export.
And we're sick of being the consumers of last resort. Times are tough in the USA. Listen up, who? I got something to say. Help us out. You know what I'm talking about. The RMB's too low without a doubt. Now I ain't saying you're a currency manipulator, but you ain't letting the UN flow. Protectionism ain't cool, it's understood. An undervalued UN inflates the price of US goods.
You are the one to blame for the Great Recession. So don't come around looking for concessions. You are in no position to call me a sinner. Without Bretton Woods, you be Argentina.
They're not enemies, but frenemies. With Kojic and an economy for stability, China's gotta export, and the US is a buyer of last resort.
And now, before we leave you, a quick note about next week's show. We'll be coming to you from Dubai exactly a year after the Gulf Emirate was plunged into a debt crisis, which few people saw coming, and brought the company Dubai World to the forefront of international business. We brought you a special edition of the show from there last year. We are going to go back to our same location. There we were, 42 floors above the city, to see what's changed, what's improved and what hasn't. That is a Counting the Cost special edition from Dubai next week, the first run at 14:30 GMT on Friday the 26th of November. In the meantime, don't forget Counting the Cost online. Here's the page. You get there from the business tab at aljazeera.net/English. This episode goes up there in full. A blog will accompany it. Previous shows are up there as well to catch up on. And this is our Twitter page as well. We update what's coming on the show, put up some interesting business links there. It's the easiest way to get in touch with us as well. At AJ Counting Cost is the name to look for on Twitter. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.